Picture yourself sprinting in a race, lungs burning, only to see the finish line vanish into the distance. That's mainstream financial advice. A treadmill of scarcity, not a path to wealth. Dave Ramsey's advice: cut costs, avoid debt, and save diligently, offers stability, but for many, it reinforces a survival mindset rather than encouraging long-term wealth building. While you're agonizing over $5 lattes, the wealthy zoom past, building empires, seizing opportunities, and turning money into more money. We're torching the old playbook to reveal the elite's wealth-building secrets. Get ready to rethink everything and ignite a mindset for abundance. Welcome to Blue Chip Mindset, the winning mindset for success. If you enjoy the video or learn something new, please give it a like. Myth number 1. All debt is evil. Dave Ramsey paints debt as the devil. Pay off every loan, shred credit cards, live debt-free or bust. Runaway credit card balances can indeed choke your finances, turning paychecks into interest payments. But banning all debt is like refusing a ladder to climb higher. The wealthy use smart debt as rocket fuel. Imagine buying a rental property with a low-interest mortgage. Tenants pay it off while the property's value soars. Or picture an entrepreneur borrowing to launch a business that scales fast, turning a small loan into a cash-flowing machine. Debt, used strategically, is a powerful tool for wealth building as it leverages someone else's money to increase your returns. The trick is borrowing for assets that grow, not for vacations or gadgets. Ramsey's debt-free obsession keeps you grounded and safe but small. The rich borrow strategically, using debt to open doors cash can't. Learn to spot opportunities where a loan's return beats its cost, and you'll build wealth faster than scrimping ever could. Wise use of debt allows you to scale your investments and seize opportunities without waiting years to save up the capital. Myth number 2. Cash is always king. Pay cash for everything, Ramsey declares. It feels secure, but in reality, hoarding cash in a high-inflation economy is like filling a leaky bucket. Over time, your purchasing power just drains away. That car you're saving for keeps getting more expensive, while your savings barely budge. Ramsey's emergency fund is a solid shield, but the wealthy treat cash as a tool, not a throne. They keep enough for emergencies, then pour the rest into assets, stocks, properties, businesses that grow faster and costs rise. For example, let's say you're eyeing a $30,000 car. Ramsey might tell you to save up and pay cash. But here's where the wealthy play a different game. Instead of letting that $30,000 sit in a savings account earning next to nothing, consider financing the car at a 3% interest rate. You keep your $30,000 in hand and invest it in a diversified portfolio of index funds or real estate that yields an average return of 7 to 10% annually. In 5 years, that $30,000 invested at 7% could grow to around $42,000, outpacing the cost of the car loan. Now, you're not just buying a car, you're building wealth with the same money you were planning to use for a single purchase. While your loan payment stays fixed, your investments are growing at a rate that outstrips the loan's interest. The principle is simple: leverage low-interest debt to keep your cash working for you. Ramsey's cash-heavy approach locks you in safety, leaving you sitting on your money while the world moves on. The rich play offense, investing and letting their money work harder to outpace inflation, rising costs, and opportunity. Keep liquidity, but don't let cash sit idle. Invest it to outrun the rising tide of expenses. Myth number 3. Budgeting is the ultimate solution. The world says budgeting is your ticket to riches. Track every dollar, live lean, and you're set. Ramsey's zero-based budgeting, giving every dollar a job, stops leaks and keeps debt at bay. But it's not a wealth machine. Obsessing, overcutting out coffee, or canceling streaming subscriptions is like patching a sinking ship with duct tape. It might slow the leak, but it won't keep you afloat in the long run. The wealthy focus on earning more, such as starting a side hustle, negotiating a raise, or acquiring a skill that doubles their income. Imagine investing in a course that lands you a freelance gig, turning spare hours into thousands monthly. Budgeting keeps your money in line. Income growth sets it free. Ramsey's method ensures control, but the rich chase bigger paychecks and then channel them into investments. Don't just tighten the belt, build new streams to fuel wealth that budgeting alone can't deliver. Myth number 4. Renting is throwing money away. Buy a house, renting just pays someone else's mortgage. Ramsey preaches treating homeownership like a gold medal. But buying a home can tie up your money in costly repairs, like $7,000 for a new roof or $2,500 to replace a furnace, plus property taxes and the months it takes to sell when opportunity knocks. Ramsey champions buying a home once debt's cleared, but renting keeps your options open and your capital free, allowing you to stay nimble for unexpected opportunities. In pricey cities, the wealthy rent, freeing cash to invest in businesses or markets that grow faster than a house's value. Picture renting to stay flexible, moving for a dream job, or redirecting a down payment to a venture that doubles your income. Renting isn't tossing money away, it's choosing mobility over anchors. The flexibility to move quickly can open up doors that homeownership often locks. Ramsey's homeownership dream suits some, but the wealthy prioritize returns over deeds, focusing on investments that truly multiply their wealth. Don't buy the myth that renting's a failure. Calculate what ties up less capital and fuels more growth, whether it's a lease or a mortgage. Myth number 5. You need a big salary to get rich. Land a six-figure job and you're golden. Not true. Most millionaires aren't flashy CEOs. They're regular folks who master the game, saving small but steady, investing early, and dodging the urge to splurge on status. Ramsey nods to this, stressing discipline over income. A modest earner who invests monthly in a stock fund can outpace a high flyer blowing cash on luxury. Picture a teacher stashing $200 a month in a low-cost fund, building a $500,000 nest egg over decades. In the book The Millionaire Next Door, the authors found that many self-made millionaires earned modest incomes but built significant wealth through consistent, disciplined habits. One standout example was a 55-year-old engineer who had accumulated $10 million, not by chasing high salaries but by living frugally, investing regularly, and resisting the temptation to spend lavishly. He drove a modest car, lived in a reasonably priced home, and focused on growing his assets instead of upgrading his lifestyle. This pattern was typical among the millionaires studied. They lived below their means, invested in blue-chip stocks and real estate, and kept a long-term view. Instead of chasing raises, many created new income streams, learning high-demand skills, launching side businesses, or leveraging smart debt. Ramsey's emphasis on frugality lays a strong foundation, but wealth accelerates when you expand your earning power. Don't wait for a big paycheck. Start small, stay consistent, and focus on habits that multiply both income and assets. Myth number 6. Safe investments are the safest bet. Stick to CDs or bonds, play it safe. Ramsey suggests mutual funds once debt's cleared, but safe investments like CDs are a losing bet when prices rise faster than returns. The wealthy take calculated risks, investing in stocks, real estate, or startups that have the potential to grow their wealth. Imagine investing $10,000 in a diversified stock fund. Over time, it could triple, while the CD barely budges. Risk isn't gambling if you study markets and spread bets across assets. Ramsey's caution keeps you stable, but playing too safe leaves you trailing life's rising costs. The rich learn enough to invest boldly, balancing stocks or properties for growth. Picture a small real estate deal that pays monthly dividends, outpacing any savings account. Don't hide in safe options. Research markets, start small, and let calculated risks build wealth that Ramsey's conservative path can't match. Myth number 7. Financial advisors are your ticket to wealth. Hire a pro. They'll make you rich. Wrong. Ramsey pushes learning basics, stocks, bonds, and tax strategies, and then relying on vetted advisors to guide your wealth. That's still handing over too much control, like letting someone else drive your car while you're in the backseat. The wealthy don't wait for advisors' approval. They dive in, mastering markets themselves through books, podcasts, or high-value networks like investor clubs. Picture studying index funds online, then bypassing an advisor's cookie-cutter plan to build your own portfolio. Ramsey's cautious path, learn then lean on pros, keeps you tethered to their fees and agendas. The rich act independently, using mentors or peers for insights rather than directives. Don't outsource your financial future. Tap free resources like investing forums, learn fast, and make bold moves yourself. Wealth grows when you captain your own ship, not follow someone else's map. Myth number 8. Frugality is the whole game. Live on rice and beans, Ramsey preaches to escape debt. Frugality clears the path like laying a foundation for a house. It's essential, but not the whole structure. Making it your entire plan is like building walls and stopping there. The wealthy start with discipline but pivot to growth. Launching ventures, joining high-value networks, or mastering skills that spark big wins. Picture enrolling in a course that turns your evenings into a thriving freelance business. Ramsey encourages investing after debt, but relentless cost-cutting keeps you fixated on what's out of reach. The rich see money as a seed to plant, not a pile to guard. Frugality sets the stage, bold action builds the empire. Invest in a mentorship or a new skill to unlock income streams that soar beyond Ramsey's tight budget blueprint. Let's take action and build wealth on our terms. If you enjoyed the video, please like and subscribe.